Over the last few years, AI-driven quantitative projects have flooded forums, pitch decks, and open-source repositories. Many promise that large language models or automated factor generators will finally crack the alpha code. Yet look closely at live performance, and a different picture emerges. Most of those models quietly dissolve when real money is at stake. Today we move past the hype and dissect two of the most watched open-source initiatives from Microsoft, Qlib and RD Agent. What can they actually do? Where do they fall short? And, most critically, can an AI researcher ever replace human judgment in the hunt for genuine, replicable alpha? The answer lies not in smarter models, but in a process most projects ignore. Before any tool can help, we have to confront an uncomfortable truth. Most public AI quant projects are designed to look intelligent, not to conduct serious experiments. They might generate a beautiful backtest curve, or have two agents debate bulls and bears, but when exposed to live markets the results are often disastrous. The reason? Real alpha has never been about idea generation. A capable researcher can conceive a factor in a day, then spend months verifying that the signal isn't contaminated by data leakage, isn't a statistical fluke, and still works after trading costs. That grueling verification, not the initial spark, separates fantasy from finance. Qlib's core value is precisely here. It doesn't print money, it transforms a chaotic pile of notebooks into a standardized, auditable experimental pipeline where mistakes can be caught early. To see where Qlib fits, we first need a mental map of what quantitative equity research actually studies. The dominant framework is cross-sectional machine learning. You start by defining a stock universe and a historical time range. Then you construct features, often from price history, fundamentals, or alternative data. Next, you define a label, for example, the forward 5-day return relative to a benchmark. The crucial point is that the model isn't learning whether a company is good, it's learning whether these features provide any stable information about the cross-sectional ordering of future returns. Cross-section means comparing many stocks at the same point in time, as opposed to time series analysis of a single asset. Conflating the two invalidates the entire framework. Qlib's architecture is built to enforce this distinction, wiring data ingestion, feature engineering, model training, and backtesting into one coherent research assembly line. Without a platform, a typical quant research setup is a fragile chain. One script fetches data, another computes features, a third trains a model, and a fourth, often written by a different person, runs the backtest. Every handoff introduces errors. Qlib replaces this with a modular infrastructure where each component exposes a standard interface. The data handler guarantees point-in-time integrity, the feature module ensures consistent transformations, the model zoo offers reusable learners, the strategy module translates predictions into portfolio weights, and the evaluation module computes returns, drawdown, and turnover uniformly. This is not a magic alpha generator, it's a laboratory. Just as a clean bench doesn't guarantee a discovery, Qlib doesn't guarantee profits. It guarantees that when you get a result, you can trace its origin, reproduce it, and, most importantly, stress test it against known failure modes. The deepest source of false alpha is look-ahead bias, and it rarely looks like an obvious bug. It hides in the way data is stored. A company's March annual report may only become publicly available in May. If your backtest uses the cleaned, final version database, where all restatements, index additions, and survivorship have been corrected retroactively, your January model will quietly peek at numbers it shouldn't see. Qlib's point-in-time module enforces that every training observation can only use information that actually existed on that calendar date. It also handles tricky cases like index constituent changes and delisted stocks, preventing the classic survivorship bias that inflates historical returns. In professional research, the first discipline is not chasing higher backtest numbers, it is ensuring that the simulated strategy saw exactly what a real investor could have seen at each moment. Even with clean data, small definitional choices can flip a factor from profitable to worthless. The same momentum idea can be expressed as the past 20-day return, the past 20-day return skipping the most recent 5 days, or an industry-neutral version. Each substitution changes the signal. Labels are equally sensitive. Predicting absolute return, excess return over a benchmark, or cross-sectional rank teaches entirely different things. A shiny backtest often turns out to be a definition game. Change the label slightly and the alpha vanishes. Qlib forces you to declare these choices explicitly in its configuration, making it harder to inadvertently cherry-pick a favorable setup. Good feature engineering is not about quantity, it's about cleanliness, economic rationale, and consistency across market regimes. In cross-sectional stock selection, 3 statistics dominate the early stage evaluation. IC, or information coefficient, measures the linear correlation between today's factor value and the next period's return. It captures predictive power, but it is sensitive to extreme observations. RankIC replaces raw values with ranks, making it robust to outliers, a crucial property in financial data. ICIR, the information coefficient divided by its standard deviation, summarizes how stable that predictive edge is over time. A factor with a high average IC but a wild roller coaster is useless in practice. However, a decent IC doesn't guarantee a profitable portfolio. The signal may concentrate in microcap names, come with extreme turnover, or merely replicate existing style factors. True evaluation demands drilling into group returns, sector exposures, turnover, capacity, and post-cost performance. If Qlib is the laboratory, RD Agent is the tireless research assistant. It attempts to read financial literature, formulate candidate hypotheses, generate executable code, run experiments on a unified data backbone, and then refine its ideas based on the results. Imagine it scans a paper on short-term reversals and liquidity. It might propose a composite signal. When prices drop sharply on elevated volume but the long-term trend remains intact, a reversal may be stronger, then automatically code, backtest, and log that trial. The genuine value is acceleration. A human managing 10 ideas a day is limited by typing and caffeine. RD Agent can propose and screen 100. But the output is only as good as the constraints you build around it. Without guards, the machine will eagerly chase the highest in-sample Sharpe ratio, regardless of economic sense. Here is where the promise of AI-driven research turns dangerous. When a human tests 10 ideas per day, discipline can be enforced by sheer exhaustion. You remember how many iterations you ran. When an agent can silently sweep through 1,000 combinations, the default outcome is that it becomes a supremely efficient machine for finding historical coincidences. AI does not inherently respect out-of-sample boundaries. It will over-optimize toward whatever metric you reward, tunneling into the noise structure of the specific historical dataset. A backtest Sharpe of May 3rd reflect nothing but data snooping. The danger scales with automation. The faster you test, the faster you can fool yourself. That means adding RD Agent to Qlib without a rigorous multi-layered validation framework is not a productivity boost, it is a recipe for accelerating error. The correct pairing of Qlib and RD Agent is not a direct pipeline from backtest profit to live trading. It is a funnel with 6 sequential screens. First, a data audit that verifies point-in-time integrity, corporate actions, and survivors. Second, a research log that records every trial, parameters, failure modes, and discarded ideas, so the team can gauge the true cost of data mining. Third, a strict out-of-sample reserve that remains locked until final selection, preventing it from becoming another training playground. Fourth, walk-forward validation that simulates periodic retraining on an expanding window, revealing strategy decay. Fifth, a portfolio and cost layer that translates signals into positions under realistic spread, impact, and constraint assumptions, where many paper alphas evaporate. Sixth, paper trading that runs live on real-time data without execution, testing signal delay, fill stability, and operational integrity. Only outputs that survive all 6 gates earn the right to a small-scale deployment. As routine tasks become automated, the quant's job is not eliminated, it is elevated. Instead of spending days debugging a data loader, the researcher designs the experiments, which hypotheses are worth testing, which validation criteria must be met, and where the risk boundary lies. A good research platform, like Qlib with proper gatekeeping, makes errors visible earlier. The human becomes the auditor, the falsification architect, and the final interpreter of failure. When 100 AI-generated factors land on your desk, the skill is not in picking the one with the highest IC, it is in understanding why it exists, under what conditions it breaks, and whether it adds genuine diversification. The industry's future belongs to those who can frame the right questions and build processes that are systematically distrustful of clean results. So, can AI researchers discover alpha? Yes, but only within a system that is designed to be skeptical. Qlib provides the standardized laboratory, RD Agent offers the speed to explore. Yet without the 6 gates, data audit, research log, out of sample, walk forward, portfolio costs, and paper trading, any automation will simply search faster for noise. Generating a factor is cheap, proving it isn't an illusion is the real research craft. As the tools mature, the value of human judgment does not shrink, it concentrates on the high-stakes decisions that no machine can make, what risk is acceptable, what question is worth asking, and when a promising result is just too neat to trust. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.